So today we would be discussing about marginal cost equation, or in other words, CVP analysis. In this class, we would be trying to understand what is the meaning of CVP analysis, the concept of contribution before we could derive at the marginal cost equation. And once we understand the concept of contribution, we will try to understand the marginal cost equation derivation. And also we will discuss about the formula for calculating PV ratio, the meaning of PV ratio, importance of PV ratio. We will also be understanding the BEP analysis. What is break-even point? What are the different ways of calculating break-even point? And then we will be moving on to margin of safety, the meaning of margin of safety and the formula to calculate the margin of safety. This is what we would be looking in today's class. So a quick look at CVP analysis. What is CVP analysis? CVP analysis is a technique of studying the relationship between cost, volume, and profit. Basically, your profits are dependent on large number of factors. The factors are many, but among them, the most important factor is the cost of manufacturing, the volume of sales, and what is the selling price of the product. The difference between your selling price and the cost price is nothing but your profit. So why we require CVP analysis? I told you CVP analysis is a technique that is used for studying the relationship between cost, volume, and profit. We try to establish a relationship, a mathematical relationship between cost, volume, and profit. The cost of manufacturing, the volume of sales, and the selling price. Now the question is, why do we need a CVP analysis? There are three important applications of CVP analysis. Because of CVP analysis, you can have profit planning, you can do profit planning, you can control the cost, and also decision making. So CVP is a technique for profit planning, cost control, and decision making in an organization. So now let's see how this relationship is being established between these three factors. What are those three factors? Cost of manufacturing, the volume, and the profit that you have been generated. So basically, we try to use mathematical connection between these three important factors. So they are interconnected and dependent with each other. All these three factors are interdependent and they are interconnected. So CVP analysis makes an attempt to make this analysis of showing or depicting the relationship. Example, the profits depend upon the sales and the selling price depends upon the cost, and the cost depends upon the volume of production. So the cost could be variable or it could be fixed. Now, what are the uses of CVP analysis? By doing CVP analysis, we are going to go for profit planning, cost control, and decision making. But how? These are different questions that we answer when we are doing CVP analysis. How much sales should be made to avoid the losses? Break-even point. How much should be the sales to earn a desired profit? If I want X profit to be made, what is the volume of sales that I have to make? Or what is the amount of sales that I have to make? Next is, what will be the effect of changes in prices, cost, and volume on profit? If there is a change in price, if there is a change in the cost, if there is a change in the volume, what is its effect on the profits of the company? The next situation is, which product or product mix is more profitable? A company would be manufacturing more than one product. So what combination of production of these products would lead to profitability? Last but not the least, should we manufacture or buy some product or component? A manufacturing company might be a component of the product would be manufactured by itself or it could be purchased. Now, which is beneficial? Either manufacturing or buying. Make or buy decision is possible because of CVP analysis. So our problems on CVP analysis would be on these questions only. Next, coming to derivation of marginal cost equation. We all know that our sales is equal to variable cost and contribution. So our sales is equal to variable cost plus your contribution can be rewritten as fixed cost plus or minus profit or loss. So plus profit minus losses. So contribution is further segregated as fixed cost plus profit or loss. So sales minus, it can be rewritten as sales minus variable cost is equal to fixed cost plus profit or fixed cost minus loss. This is what we call it as marginal equation. If 3 factors out of these 4 items are given, we can easily find out the next. What are those 4? Sales, variable cost, fixed cost, profit or loss. So if they give you sales, variable cost and fixed cost, if 3 factors are given, you can easily calculate whether there is a profit or a loss by making the profitability statement. Similarly, if they give you variable cost, fixed cost, profit or loss, you can easily calculate your sales. This is what we call it as marginal equation. Now the base for marginal equation is your contribution. So what is this contribution? Contribution is nothing but it is the difference between sales and variable cost. Sales minus variable cost is equal to contribution. So the formula to calculate marginal cost or contribution is equal to sales minus variable cost. We call contribution as marginal cost. In other words, you can define contribution as excess of selling price over variable cost per unit. Excess of selling price per unit over the variable cost per unit is called as contribution. So it means that it is the amount contributed towards fixed cost and the profit. Fixed cost plus profit is equal to contribution. So it is defined as the profit before the recovery of fixed cost. And it's rewritten as contribution equal to fixed cost plus or minus profit or loss. This we call it as contribution margin or gross margin. Sales minus variable cost is called as contribution margin or gross margin. Now, what are the advantages of contribution? Because of contribution, you can fix the selling price. You can determine the break-even point with the help of contribution. Selection of suitable product mix for profit maximization. Choosing from among alternative methods of production, or deciding whether to purchase or manufacture a product or a component. Take decisions regarding adding a new product or maybe discontinuing a new product. Contribution, we keep this as the base to decide the selling price. So any problems based on deciding the selling price of a product, if you want to calculate break-even point, if you want to select the suitable product mix for a profit maximization, or you want to choose among the alternative methods of production, or you want to decide whether the purchase of manufacture or a product or a component is to be purchased or not purchased, if you want to make a decision on that, or you want to add a new product to the market, or maybe you want to discontinue the product, contribution is the base to decide all these decisions. Next, coming to the next component of marginal cost equation is profit volume ratio. So, or in other words, we call it as contribution ratio or marginal ratio, we call it as. This expresses the relationship of contribution to sales. So, PV ratio shows the relationship between contribution and sales. What is contribution? Contribution is nothing but sales minus variable cost. So, it is expressed as in different formulas we have. So depending upon the situation, we use the formula. PV ratio is equal to contribution divided by sales. PV ratio is equal to sales minus variable cost divided by sales, because your contribution is rewritten as sales minus variable cost. Similarly, it can again be rewritten as your sales minus variable cost is equal to fixed cost plus profit. So PV ratio can also be calculated using your fixed cost plus profit divided by sales. And the other formula is change in profit or contribution divided by change in sales is also one such formula. When you don't have the fixed cost given in the problem, only when profits of 2 different years and profits of sales of 2 different years are given, that time you're going to use PV ratio, the fourth formula. Otherwise, you're going to use, depending upon the scenario, these 3 formulas. Next, moving on to, this ratio is always shown in percentage. You should always keep in mind that when you calculate the PV ratio, it is always expressed as a percentage. Either you multiply it by 100 or not. Contribution divided by sales will be expressed in percentage. Next is, what is the importance of PV ratio? So for studying the profitability of business units or business operations, PV ratio is used in order to show the effect on profit of changes in volume. If there is a small change in volume, what is the change in its profits? Because look into this question. Your denominator is sales. So any change in the volume, what would be the change on the profits? So identify which product or process or department is profitable. Now, how do we decide using PV ratio? A higher PV ratio denotes high profits and a lower PV ratio denotes lower profits. So once you calculate the PV ratio, the decision would be, or the comment would be, a high PV ratio, high profits, a lower PV ratio, lower profits. Now, application of PV ratio. Where do we apply PV ratio? It is used to increase the ratio by increasing the contribution. So if I have to understand, if I have to get a higher PV ratio, because I told you a higher PV ratio is always preferable. So a higher PV ratio denotes higher profit. So if I want to increase my profits, then I have to increase the contribution. How you can do that? Increasing your selling price per unit, reducing your variable cost or marginal cost, and changing the sales mixture and selling more profitable products for which PV ratio is higher. So that's how you can go for, that is the use of PV ratio. That's how you use your PV ratio. So you want to increase your PV ratio, you are going to change the contribution. If you want to change the contribution, you need to change your selling price, or there must be a change in the variable cost. What change? Increase in selling price and reduction in the variable cost should be there. That will definitely lead to your higher PV ratio. So PV ratio we also use for calculation of break-even point. We are using for calculating the profit at a given volume of sales. Then sales volume required to earn a desired profit, or volume of sales required to maintain the present profit if selling price is reduced by a certain percentage. So these are the different situations where we use PV ratio to calculate the calculate whatever we want, desired things. And next we are talking about break-even analysis. What is break-even analysis? Break-even analysis talks about how to calculate the break-even point. So before we could understand how do we calculate the break-even point, what are the formulas available to calculate break-even point, why we need to calculate break-even point. We will understand what is break-even point. So break-even point is a financial tool. For what? That helps a company to determine the stage at which the company or a new service or a product will be profitable. So with the help of BEP, you try to understand at what level of activity the business would be having no profit, no loss. So this is the first step in calculating the price at which a product has to be sold or a service has to be rendered. Because always your selling price should be more than the cost price so that you earn a profit. So it helps marketers play with different prices in order to see how many sales needs to be made in order to make the companies cover all their cost, because your selling price should cover the cost and it has to gain the profits. So break-even point, to make it more simpler, the number of units that a business must sell at a given price to cover its cost is called as break-even. So what should be the number of units the company should sell at a given price in order to cover the cost is called as break-even. A very simple definition. So once the variable cost is covered, the rest of the GP goes paid for the fixed cost. So it is sales minus variable cost and gives you contribution minus your fixed cost. So excess of fixed, when your contribution is excess of fixed cost, only then you will be earning a profit. If the contribution and fixed cost are same, you are not going to have profit nor your loss. So gross profit is the amount the company makes on every unit sold, that is selling price minus your purchase price. So the level of output at which total cost equals total revenue is called as your break-even point. Total cost equal to total revenue. So no profit, no loss. Now, what are the different methods of calculating break-even point? We have actually two important methods of calculating break-even point. We have three methods, but in our syllabus, we are including only two methods. One is algebraic method and graphical method. The algebraic method is basically a mathematical calculation that we are going to use. And a graphical method, we are going to depict or show the calculations on a graph. So in this first unit, we will be talking about graphical method. And in the second unit, in the differential cost and CVP analysis, there we are going to solve the problems based on graphical method. So in this unit, we are going to go with only graphical method. So as shown in this slide, BEP is calculated using various formulas depending upon the scenarios. So we calculate break-even point in units. It could be fixed cost divided by contribution per unit. If you want BEP in rupees, it's going to be fixed cost divided by PV ratio, or break-even units what you have calculated into selling price per unit. You have already calculated the BEP in units into selling price per unit. You're going to calculate. Now PV ratio is equal to what? Contribution divided by sales into 100. This we saw in the previous slide when we are talking about PV ratio. And further formulas that we are going to derive out and we'll be using is, we will be having desired sales, calculation of desired sales to earn a desired profit, or calculation of desired profit to earn the given level of sales. So the formula would be desired sales equal to fixed cost plus desired profit divided by PV ratio. And remember, at break-even point, your contribution is equal to fixed cost, meaning to say your contribution minus fixed cost would be 0 at your break-even point. So if you want to understand whether the break-even point you have calculated is correct or not, take the contribution and minus fixed cost from it. That means your contribution and fixed cost must be the same. Only then your break-even point is correct. So I give you an example of break-even point calculation using the formula method. So we have a situation like this. A teddy bear manufacturing company sells its bears to retailers for an average price of rupees 80. The variable cost are rupees 3 per bear. The company's fixed cost are 1,50,000. How many bears need to be sold before the teddy bear manufacturer turns a profit? That means, what is the minimum sales that he has to make wherein he could cover the cost? That is called as break-even point. So any sales above this would lead to profits. Any sales below this would lead to losses. Okay, so what is he given? You have the variable, you have the selling price, you have the variable cost per unit, and you have the fixed cost. So what you need to calculate a break-even point, fixed cost divided by contribution per unit. Fixed cost is already given 1,50,000. You need to calculate contribution. So contribution is equal to 18 minus 3. Selling price minus your variable cost is your contribution. So 18 minus 3, that's going to be 15. So 1,50,000 divided by 15 is going to be your BEP. So 1,50,000 divided by 15 would be 10,000 units. So you need to sell 10,000 bears in order to ensure that your cost is equal to your selling price. If you are going to sell 10,000, you are going to get back your cost. If you are selling more than 10,000, you will be getting profits thereafter. So your 10,000 units cover the cost. So it is suggested that the company, in order to turn profits, has to sell more than 10,000 units. The last concept is margin of safety. So what is margin of safety? Margin of safety is defined as the difference between the expected level of sale and the break-even sales. The larger the margin of safety, the higher is the chance of making profits. So margin of safety is calculated to know the chances of making profits. Your break-even sales is 10,000. Your projected sales is 15,000. So am I in the safety zone? Projected sales is 15, break-even sales is 10. Yes, it is your projected sales is more than your break-even. That means you are making more profits. The other formula to calculate margin of safety is profit divided by PV ratio. So PV ratio is nothing but what? PV ratio is, what is PV ratio? Anybody who can answer what is PV ratio? What is the formula to calculate PV ratio? PV ratio equal to contribution divided by sales into 100. Okay, so you need to calculate PV ratio, and if you have the profit, if you divide it by the PV ratio, you get the margin of safety. And now in the coming classes, we will be solving the problems on calculation of contribution, calculation of PV ratio, and break-even point.